Hello, this is Mike Wade, Chief Options Strategist for Tom Gentile, and welcome to this video featuring Tom's tools and yours truly. Stock and options trading has large potential rewards, but also large potential risk. You must be aware of these risks and be willing to accept them in order to invest in the stock and options market. Don't trade money you cannot afford to lose. You can lose money in trading, you know that. You also know that I am not an advisor, and please don't construe anything I'm about to share with you as advice. All prices are in US dollars unless noted otherwise, and of course, feel free to pause the recording and read the balance of the disclaimer. Now, I've been trading for 22 years plus full-time. I quit my job in '98, and I've used a lot of different option trading tools, and there's none on the market that I've ever seen that come close to what Tom's tools do. There are a plethora of different options for you. One I want to highlight today is Tom's Smart Searcher. This is really good for the novice trader. The advanced trader can use it as well, but certainly if you're just getting started, and as the name implies, Smart Search, there's just a lot of smarts behind this search. So I want to dig into this and show you under the covers what's so smart about it. In this video, we're going to be talking about trading smart with Tom's Smart Search, finding trades with the Smart Search. We're going to look at three things. I want to dive into the basic option strategies that are available in the Smart Searcher. I want to talk about implied volatility and what that does to your option strategy selection. And then lastly, I want to talk about some very basic trade management. So let's hop right into Tom's tools. First off, I want to show you that I'm back tested to January the 2nd, 2020. I like to use the back testing tools because this is really our time machine. It allows us to actually practice historically just as though we were actually trading on that date. So I'm going to illustrate with some case studies. The first one is on January the 2nd, 2020. All right, so let's get into Smart Search. How do you find it, first off? Well, you go to Searchers, Multi-Strategies, and then Smart Search. Now, Smart Search does a lot for you. First off, when you hop in, it's going to give you a stock chart and an implied volatility chart. I'll come back to those in a minute and talk to you about why both of them are very important. And then what the Smart Searcher allows you to do is to have the searcher go out and pick potential stock trades for you. You can also pass your own list. You can specify your own stock, which is what I'm going to do here. And then from there, you can specify a particular strategy. Now, this is something I want to spend a bit of time on before I go further. First off, you'll notice that we have some basic strategies right here listed under the strategy section. For bullish, we have calls and bull call spreads, or long call spreads, they're also called. Those are bullish opportunities. We have bearish trades, buying a put or buying a bear put spread. Both of those are bearish things. We also have high implied volatility selections, bull put credit and bear call credit. These are credit spreads, and they're typically used when the implied volatility is high. All right, so if you look down here, this is our implied volatility chart. So this will help us determine whether or not we want to go after your basic bullish or bearish, or if we might want to invoke a bullish or bearish credit spread, which will operate better in a high IV environment. And then we have some more complex sideways strategies like calendar spreads and butterflies and iron condors. So if you're so inclined, those are slightly more advanced strategies, but really great strategies to employ in the event that you have a sideways prognosis. And then we have low IV trades like straddles and strangles. Typically, they're used around earnings. Sometimes you can use them before earnings to capture IV as it rushes in. Then we have stock and options trades like collars, covered calls, and married puts. Those are the basic strategies. There's other option strategies, but those are the ones that most people use. And all of them are accessible right here from the Smart Search dashboard. So let's do an example. I'm going to pull up a chart, Goldman Sachs. Now, I had a bullish prognosis on Goldman Sachs for a lot of reasons on January the 1st. First off, Goldman Sachs was reaching all-time highs. Goldman Sachs was also in the financial sector, which was the most bullish sector going, or one of the top three anyway, as well as the market was also setting new highs. So for me, Goldman Sachs was a no-brainer. It was a stock I wanted to get in, and I wanted to get in for about a month. All right, so there's the chart, and you can see the chart is also showing a very bullish move. Certainly from this point to there, you can see bullishness in the chart. Now, the next question that you should have when you're placing an option trade is, what's the implied volatility? To answer that question, you scroll down to the chart here, the IV chart, and it will tell you whether the IV is high or low based on where it's been in its range. So notice here that the IV has been as high as just over 32 and as low as just above 16, and is currently in the low 20s. All right, so it's in the low part of its range just looking at the picture, you can see that the IV is down here when it's been as high as there, and that would constitute low implied volatility. So having answered that question, then I can come up here and select something bullish. So I could select a call or a bull call spread. We'll try both. First off, before I click one of these buttons on Goldman Sachs, I want to make sure that I've selected high quality trades only. I'm going to click the call option here, the call button, and let's see if it comes back with any particular trades. Notice that it didn't. And the reason that it didn't is because of the price of the stock. The stock's at over $230, so the options are a little too expensive. So we can use a bull call spread to reduce the cost of entry. So let's click bull call spread, and this is what comes back. All of these are ranked by bullish percent to double. You notice here that the top one has a 3.79% to double, which means the stock goes up 3.79%, and you've doubled your money on that trade. So that first one would be a good one. I like this second one though. It's just it requires a little more movement to the upside to double our money, but it gives us a lot more upside. Maximum profit over risk is maximum return on investment. So you could go for either of them. I want a chance to make more money, so I'm going to go ahead and select this second one here. And let's take a look at the risk graph. Notice that it's going to cost me $130 to get into a trade that would normally cost me $320 to buy just the call option. So what did we do here? We bought the 245-250 February bull call spread that expires in 50 days. This gives me 50 days of time to be right in this trade. So I've got a trade that's costing me $130. If I want to have my position size be $500, then in this case, I might select 4 contracts by changing the 1 to a 4 under num, and that'll get me 4 contracts, and click the risk graph button again, and that will get me up just over $500, $520 of risk. So there's my trade. The most I could lose is $520. I'm bullish on the stock. You can see the stock's been on a nice bullish trend. Now, what I might want to do on this trade is get out at a double. That's a really good money management rule. Especially if you're just getting started, what I would recommend that you do is take your long trades off at a double in the event that you're right, and take off your trades for a 50% loss in the event that you're wrong. So in this case, we got in on January the 2nd, and then on January the 16th, just about 2 weeks later, notice that we had 124% return on investment on this long call spread. What happened? Well, the stock actually took off to the upside and put us in a position where we were over a double. The day before, we weren't quite a double. The stock gapped up and left us in a position of 124% profit. That is an excellent point at which to exit this trade and then move on to the next one. All right, let's do another example. I want to take us back to 2018 and November 1st of that year. That's a couple of years ago. I want to show you what was going on in the SPY. So I'm back into Smart Search. I've back tested myself to 11/1/2018. And I want to show you what I was looking at in terms of the SPY. Notice here that the S&P 500 was collapsing essentially. So in early October, the markets collapsed. The SPYs had made a slight run up, and the implied volatility was also elevated. Notice how the implied volatility is high compared to what it had been in the prior months. So now we're looking at a situation where I, in this particular case, was bearish. I was anticipating further downside, and now I'm looking at high IV, and instead of going for a bearish put or a bear put spread, because the implied volatility is high, I'm going to select bear call credit. Here's what's come back. You'll notice here we have probability of profit shown. The first one on the list offers a 91% probability of profit, but only the ability to make 5%. What I like to do is make at least 1 percentage point a day, and looking down this list here where it says days, notice that we get to 15 days. There's one that offers a 16% potential return on investment. That's what I want. I want to make at least 1% a day. That's a good rule of thumb on a credit spread. This is 15 days making 16%. That's a good looking setup. So I click either of the risk graph legs, that pulls up the actual trade. This is called a credit spread. We're going to be selling the 283 call and then buying the 284 call. This is for November 16th of 2018. This is a 15-day trade. Look at this beautiful risk graph. You can see that there's some nice profit on this thing, and we get to keep that profit as long as the stock stays below this light blue line here. And the probability of that happening over the next 15 days, the life of the trade, if I scroll to the bottom of the screen, is 90%. So a 90% chance, statistically speaking, of making 16% on our money. Now, rules of thumb for managing credit spreads. Here's one. Get out if you can capture 80% of your maximum credit. In this case, it means buying back your spread for 20% of what you sold it for. And that's, in this case, that would be right around 3 cents. So if I can buy this spread back that I sold for 14 cents for 3 cents, then I've captured 80% of maximum profit on this trade. Now, of course, I want to do more than one contract in this case. With 86 cents of risk for one contract, for me to make the risk on this trade a maximum of $500, give or take, I'm going to need to do 6 contracts. So I'll change under num the number of contracts to 6, hit risk graph, and now my risk in this trade is going to be in the neighborhood of $500, just over $500. I can make $84, 16% return over the next 15 trading days. You can see there. Now, how do we manage this trade? Again, we want to buy it back for 3 cents per contract. In the event the stock goes against us, we want to buy this back for twice the credit. That would be for a stop loss. In that case, we would be buying this back for 28 cents as a stop loss. So if the value of the spread increases to 28 cents, then I would automatically buy that back. Now let's take a look and see what actually happened. Here's the actual stock. You can see the stock made a run up and then fell away. This was with 4 days to go before expiration. And you can see here that we're right in the neighborhood of 3 cents. We would have bought this spread back for 3 cents and captured 16% of our profit in this particular trade. So this was a winning trade. Had the stock gone the wrong way or continued to go against us as it did here and went up beyond this break even, we would have ended up buying the spread back for 28 cents and losing our original credit. So as a review on basic trade management for long calls, puts, and spreads, I'm going to suggest that you get out at 100% profit, or if you lose 50%. On credit spreads though, take your profits when you can buy the spread back for 20% of what you originally sold it for. And on the loss side, buy it back if the spread doubles in value from the original credit. So you'll be buying it back for twice what you sold it for, and your net loss would be the actual credit that you originally sold. Also consider using good till cancel orders, GTCs, and one cancels other orders in order to automate both the profit and the loss exits in a good till cancel fashion on each of these trade types. So as review, here's how you use Smart Search. You go into searchers, click multi-strategies, click Smart Search, specify the stock that you're interested in, and additionally you can give it a list of stocks or have it analyze a stock list for you. Click Change to update the stock symbol in this case. What we did is we clicked Call on the first opportunity, and on the second opportunity we clicked Bear Call Credit. All right, so there's a lot of power in this particular searcher, this Smart Search. It's very smart. Do yourself a favor and dig in and practice this. Use it in backtest. You'll be very glad you did. I hope you enjoyed the video, and I will see you next time.